Good afternoon, everybody. Thank you for joining this week's weekly Wednesday webinar. I'm Chris Orestes, and it's a pleasure to once again host you for a 5-minute brainstorm. This week, we're going to talk about when is it too late to obtain long-term care coverage? And this is a very topical point to discuss because, as we all know, working in this profession for so many years, people just don't like to think about long-term care. It's an issue they avoid. They delay dealing with it. Many people are confused about what's covered, what's not. There's a lot of assumptions, a lot of wrong assumptions that people are making about their future when it comes to long-term care. But when it comes to getting insurance-based coverage, when it's long-term care or any other form of coverage, as always, the younger and healthier a person is, when they're buying coverage, when they're getting coverage in force, the cheaper the premium is going to be, the better the coverage is going to be, the more options they're going to have available to them. But for so many people, particularly when it comes to long-term care, this is just not insurance that people are getting in their 20s, their 30s, their 40s, even their 50s. And it really starts to become something that becomes relevant to people as they're aging, as they've experienced a health challenge. And so I'm often asked the question, so what options are available to people if they've waited a little too long? Now they're into their senior years, they're in their 60s, they're in their 70s. They've had illness, they've had an injury, they've got a chronic condition in their past or something they're dealing with now. They might even need care immediately, an immediate need for care. And they now are looking at, well, how do we pay for it? Well, there's a variety of ways to look at how to qualify for insurance coverage and alternatives to insurance coverage. And let's spend the next few minutes going through that. First, there's traditional long-term care insurance. And this is when being written, particularly at the individual level, just traditional long-term care insurance purchased in the individual market, that is going to be subject to underwriting, which will include a review of medical history, and that's going to be part of the process. But your current health and functionality is going to really be a prevailing factor in qualifying for care. So maybe you're older now, you're in your 60s, your 70s, maybe you had cancer earlier in your life, or were in an accident, had an injury that you've recovered from. It's important to remember that long-term care insurance underwriting is morbidity based. So they're looking at the potential of impairments and the need for long-term care services versus mortality-based underwriting. So they're looking at your current health, your current functionality, and they're going to be looking at your past, but they're going to be taking into account, have you recovered? Are you relatively healthy today, either age or based on your past health history? Then there's hybrid combo policies, which are life insurance policies being issued with conversion options to long-term care benefits. And I'd say over the last decade, that has certainly been a growing popular way to obtain long-term care insurance related coverage. When getting this kind of coverage, it's interesting that the underwriting is actually mortality based. This is written and priced as life insurance with a conversion factor later down the road, kind of like an accelerated death benefit. When wanting to trigger the long-term care benefit, you need a doctor's certified diagnosis to trigger those benefits. But for many people, they consider this to be easier to get into a hybrid policy because it's mortality-based underwriting on life insurance tables versus a standalone long-term care insurance policy, which is morbidity-based underwriting on long-term care disability tables. Group long-term care insurance is really where I'd say the majority of long-term care insurance coverage is secured today. Really, it's through employee benefit plans. So in that situation, it's group underwriting, which is going to be a guarantee issue. And for many companies who provide this benefit, It's going to be at little or no cost for the person securing long-term care insurance. And if they leave their employ, then that's a policy they can take with them and then continue it individually. So if they're employed and they're older, if they're employed and they've had conditions or currently are experiencing conditions, this is actually a way to get into a long-term care insurance policy and then hang on to it past your employment. Also, another way, sort of deviating away from long-term care insurance coverage, but still a variety of ways to secure coverage for future conditions, critical illness insurance, which can be obtained as a standalone policy, oftentimes as a rider on life policies. And many times critical illness options will be presented through employee benefit plans. Critical illness covers all kinds of different diseases, conditions. There's a whole range and variety of the way critical illness is written. Oftentimes it can be guarantee issued, sometimes it could be underwritten, but if you trigger the benefit of critical illness policies, then you're getting cash payments, which you can then use towards your care, towards whatever expenses are related to dealing with the critical illness that has triggered the benefit. Then there's long-term care life settlements for people who already own a life insurance policy. If they do a life settlement in the secondary market, those funds are going to be tax-free if they're chronic, if their diagnosis and underwriting is they're either chronic conditions with 2 ADLs or more, or possibly even terminal illness with 2 years of life expectancy or less. If they qualify for a settlement and are underwritten in this way, the funds then can be deposited into a protected long-term care benefit plan. It's a bank trust account, kind of like a health savings account, which then will hold that money, protect it from anybody getting their hands on that money, which unfortunately happens a little too often with seniors and their money and family members. If they all of a sudden come into tens, if not hundreds of thousands of dollars, might be a good idea to make sure that money's protected. And then it's in an account that will make monthly payments to any form of care they want directly on their behalf for as long as the funds are in that account. Then there's also using the value of a home through a reverse mortgage, a home equity conversion mortgage, which is based on the value of their primary residence. And when you do a reverse mortgage, you can withdraw the money either in a lump sum, on a monthly income basis. You can set up a line of credit, but there's no monthly payments required back. So it's money going out, but you don't have to make any payments back on it until the person actually would either vacate the home or be deceased. But it's important to remember that the borrower on the reverse mortgage has to be living in the home while the loan is outstanding. So for a way to pay for home care, this might be an option, but it would not work for somebody who was going into assisted living or skilled nursing or memory care. Then there's the VA aid and attendance benefit. It's a monthly benefit paid for long-term care support and services that'll cover a veteran and or their spouse. If they qualify, there's an amount that would pay to the veteran as a standalone, or together as a couple, or to the surviving spouse. Different amounts are paid based on where they fall in those categories on a monthly basis to cover long-term care support and services. Many people will use this for home care and assisted living costs. Another interesting approach is something called a True Freedom Plan. It's actually a membership plan where you pre-purchase non-medical home care services from independent providers through an organization called True Freedom. It's a monthly payment plan that has no age limits and there's no underwriting requirements. So, for example, you can get in, I think, for around one of the entry level is $100 a month. To sign up, you're paying $100 a month. And then if you get to a point that you need non-medical home care supports and services, then the True Freedom Plan would kick in to help cover those costs. So there's a variety of options that people can use over the course of their lifetime, either early when they're younger and healthy, obtaining long-term care coverage, maybe a little later down the road, a hybrid policy, or adding critical illness to existing policies, making sure maybe they secure a long-term care policy through the time when they're employed, but then hanging on to it as they're getting further into the need for care and actual needing care immediately. Then long-term care life settlements, VA aid and attendance, reverse mortgage, true freedom plans. Those are all options that can be accessed almost immediately, things that could start to pay towards care within days or weeks of needing that care. So the key is really always information, that people are well informed about the range of options they have to work with, and not as an advisor limiting yourself to one or two tracks when there's a whole range of tracks that people can explore and consider early, mid, and late stage as the need for long-term care arises. So thank you all so much for joining today's session. Appreciate once again having everybody on for the weekly Wednesday webinar, 5-minute brainstorm. We'll see you again next week, every Wednesday, same place, same time. I'm Chris Orestes, and I appreciate the time that you gave us today.